This is what's happened in the market is inflation is coming down, but unemployment is going up. And if you expand that too much, that's what a recession looks like. And if you expand that in magnitude and time, that would be what scary D word depression economically would look like. And so that's sort of what's going on in the market right now. Seems like it's time for the Federal Reserve to cut rates, and they haven't. And so, while there's still good economic activity, it's growing at a reasonable rate. Inflation's coming down. We're starting to see an uptick in inflation or in unemployment rather. So that's what has everyone spooked.
You need to diversify your bonds.
The only problem you're gonna have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
Hey everybody, welcome back to Not Financial Advice, a YouTube channel where you get to see 100% of the money a random stranger on the internet has invested in the stock market. So, as you may have heard, the stock market is down about 8.5% in the last just few days, really. But at the same time, the market has performed really well over the last 5 years. Things are always less scary when you zoom out a bit. But for me, I started investing in around April of 2021. And then 5, 6, 7 months after I started investing, the 2022 bear market happened where it crashed by about 25%. So sitting there and watching it run up to here, I am well prepared to watch it go down again and pick up more cheap shares. All right, everybody, let's start with an update on how my investment portfolio is faring. Year to date, it looks like I'm up 14.3%. The S&P 500 is up about 14.4%. So around 4 or 5 points of outperformance year to date, which is really, really good. At the same time, my portfolio has also taken a massive $5,800 hit in the last few weeks. So $5,800 gone up in smoke. But stock money, it shouldn't exist to you. It should be money that you don't need for a long time. So it's not really affecting me. But I think the thing to do here is to sort of look at some of the moves I've been making, some of the different plays I've been in, and we can sort of see how some things are responding. So with that being said, like the video, subscribe to the channel. Something did happen about a month and a few days ago. I got out of 6 positions and redeployed the money in 8 others. And so this was the first time I had ever taken a loss in the stock market in about 3.5, 4 years of investing. And it was a painful lesson, but one that I'm glad I learned. And I feel a lot better about my investments having, sort of called the herd there. So let's take a look at a document I prepared when I sold some losers a little bit over a month ago. So first and foremost, I wanted to check in on Walgreens and see how that's been. At the time when I sold it, I locked in a 62% or 66% loss. I still had $423 of value, but I locked in $830 of losses in the market. Um, what was what was worse than that though was Intel. So actually we're going to start there. This is the highest value. So I locked in a 19.2% loss. I locked in $195. But it was able to recover $800 out of the market. So let's see how Intel and Walgreens have been since I cut them off a little bit over a month ago. So this is definitely I'm not going to say gratifying, but it's some confirmation that I was making the right decision on Intel. You can see there it's down about 37% in the last month. Ouch. Um, Not as bad, but also not ideal with Walgreens down about 5% in the last month. And what was the logic behind what I did here? These were companies that had flat or declining revenue from the time I invested in them till a month ago, or even there were some signs of it maybe at the time. Maybe I was tricked into liking the dividend. That was certainly the case on both of these. Or I thought that some of the companies would turn themselves around, maybe like Paramount or Foot Locker. Or I thought that the troubles the companies were facing were transitory. Hadn't we heard that? And so, just seeing these companies with free cash flow and revenue declining, seeing things like profit margins slipping, seeing things like low returns on invested capital, or anything that was a turnaround. That's the type of investment I just made that decision. I was sick and tired of it, and I didn't want anything to do with it, and I got out of them about a month ago. So let's thumb through the last three here that I got rid of, and then we're going to see where I deployed that cash and how those investments have done so far. So I'll ask you to like the video, subscribe to the channel. Let's check in on Foot Locker next. That was by order of how much money I had. This was the third position. This was the one that I was the least excited about selling. I had some other areas I was more comfortable investing in, but this one is up 16% from the time I sold it. So when I sold it, I locked in a 3% loss, locked in a $10 loss, sat out those gains, but pulled $360 of value back out. So that one wasn't as great. Estee Lauder is down 13% in the last month. Not looking great. As far as Estee Lauder goes, I locked in a 43% loss, $230. I was able to salvage 304. And so out of those investments, we can see that on one, two, three, four of those investments there, I sold out all those companies. I was right, especially on the two biggest losers there. And just directionally, I was right on getting out of all five of those companies there. Exiting those five companies as a update will mean that I have 71 total investments. Let's take a look at where I reinvested that money. So, sort of interesting how this works. The biggest area of reinvestment is one that is now also down, but I feel comfortable in being down. So the companies that I bought are stronger names with top line revenue growth, free cash flow growth, high levels of return on capital, stable or expanding margins, stronger economic moats, and just better run, more defensive businesses. So this one has not turned out as great. That one is down 16%. Of the money I salvaged and rolled over, I equal weighted about $200 or $300 in each of these positions. This is the one that I had the biggest stake built in so far. So this one's beating me up a little bit, but I feel fine about it. Now, I did get some of those funds redeployed into AutoZone, which is up about 10.6% there, which is great. Casey's is up marginally, but moving in the right direction if you zoom out. Reinvested into Home Depot, up 4.6%, down about 9% on Target, down about 2.5% on TJ Maxx, down a good amount, almost 18% on Airbnb. But I think they have earnings coming up, and it seems like things are looking a little bit better there. But then up nicely, about 7% on McDonald's. So I was right on 4 out of 5 of my sells. And then on my buys, I was right on 1, 2, 3, 4 out of 8 of the buys that I made have proven to be profitable in the last month, whereas 4/5 of the sales, those were declining fastly. So I feel pretty good about that, you guys. And I sort of detailed these 5 positions I exited, the 8 that I already owned that I redeployed those funds into. And I've just had this general sense of unease. That the market's been on a tear while we have been overdue for a recession. And as someone who's a long-term buy and hold value investor, I don't time the market as far as some people will try to pull all of their money out of the market and then wait until it gets lower and buy back in, and that never works. But I am selective about what I buy. And so some of the places I've been parking cash I've been rescuing cash and putting them into stable places, but areas where I've been looking to sort of grow the portfolio, these are all going to be different investments I've made in the last, say, 4 weeks, between as little as 20 or $40 on the small end, but some I've parked $200 or $300 on some of these bigger ones. So I've parked several $100s in Vanguard Value ETF. Parked several $100s into Vanguard Small Cap Value. They're both sort of flat-ish, up-ish, flat-ish. Couple $100 into VTI, which is down over 6%, and then around 100 or less into SCHD, which is up. Maybe up to 100 in XAR, aerospace and defense, which is flat, and then smaller amounts just sort of in VPU and VHT. So this is where I'm trying to, sort of hold the line and grow my portfolio. But unfortunately for some, and I wish I had more capital to deploy, it looks like I'm going to be getting back into some individual tech and growth names. If the trend continues, they will get beat up. And you want to stay tuned to my channel to see which companies I swoop in to buy. I'm particularly interested in Facebook, Netflix, among several others. So stay tuned, and we will catch you on the next one.